Good afternoon, everyone. Welcome. Thank you for coming in this afternoon. We appreciate it. My name is Dan Holman, and today we're going to talk a little bit about budgeting and the key metrics to your financial dashboard. I'm with a company called Management One. There's a bunch of Management One people on your right. Everybody's waving at you. Management One spent about 33 years now helping retailers grow cash and profitable sales. And more importantly, today, we're going to talk about that impact that they've had for 33 years in improving retailers' financials. As I said, my name's Dan Holman. I've been doing this for a long time, and also not really a great picture of me. You don't need to take any notes. Everybody take out their phone. We're going to use your phone, so if you have your phone, grab your phone. We're going to use your calculators in a minute. But to get a copy of this presentation and the notes and all of the presentations that have happened this week, go to m1talks.com, enter your name, your phone number, and we'll reach out to you. And so, today's story is really about retail profitability. And in retail today, profitability is not measured by all of those great acronyms that you've heard. GMROI, MMU, IMU, EBITDA, earnings before interest, tax, and adjustments, net income before tax and adjustments. Profitability in retail is measured by one thing and one thing only, and that is cash. It's something that your accountant doesn't even measure. He measures fictitious cash. Or any accountants in the room? They measure, they do a great job, really. But your accountant's always going to tell you how much profit you have has no relativity, no relationship to cash flow. And so we're going to talk about cash. And unlocking the cash flow in your business comes from your ability to unlock your financials. Put your hand up if you know what financials are. Leave your hand up if you looked at your financials for July already this month. Put your hand up if you make decisions in your business today based on this month's financials. Good for you. You might be better at this than me. All right, so let's talk about how do we unlock our financials. There are really 5 key measures that we look at in financials or in that financial dashboard. Cost of goods, contribution margin, most underused metric in retail today, contribution margin, your operating expenses, your balance sheet, and your ability to forecast cash flow. And so we're going to talk about each one of them separately. We'll talk about cost of goods. Now, cost of goods purchased is different than cost of goods sold. Your accountant loves to talk about cost of goods sold. And cost of goods sold is a calculated number. We start with how much inventory you have. We add everything you buy. We take away returns or credits, vendor chargebacks, any discounts that you might get. We add in some freight, what it costs you to get it. And then we take away your ending inventory and say, hey, this is what your cost of goods sold represents, which really has little to no direct impact on cash flow. While cost of goods purchased is a pure representation of cash out of your business. It measures how much inventory or how much cash you spent to get that inventory. Cost of goods purchased has a direct impact on cash flow. How many people measure their cost of purchase? 2, good for you guys. What do you do with that number, cost of goods purchased, how much I purchased? What does it represent to you today, my cost of goods purchased? Hopefully it represents the inventory that's in your store today. It's an indication of how much you've invested in inventory. Cost of goods purchased is something you should measure every single month. Cost of goods purchased is the key factor in determining how much cash you will have left over at the end of the month to pay your expenses. Sales minus cost of purchase, what I spent on inventory, equals the cash that I have left to pay my expenses. Does that make sense? Okay. Contribution margin. Like I said, contribution margin, the most widely underused metric in retail. Contribution margin is the measure of dollars generated from revenue to cover variable expenses, fixed expenses, and profitability. The higher your contribution margin, the lower your break-even volume. Does everybody know what break-even is? That point in the month or year where you don't make or lose money. That's your break-even. Also, a hypercritical number that we should be looking at in our performance. Where is my break-even? At what point do I stop losing money and begin to make money? Think about contribution margin like this. Let's go for a drive. Let's get in a car together. Contribution margin is the representation of revenue covering variable expenses and fixed expenses. And as we start driving up our sales line, once we have now paid for our fixed expenses, profitability can get in the car. Right? So we've got to get past that point of break even. So the higher our contribution margin is, the more money that we dedicate to covering our variable expenses, the faster we achieve break even. The faster we become profitable. Does everybody know what a variable expense is? Yeah? Variable expenses. Those expenses that change based on selling in your store. The higher those expenses are, the lower my break-even point is. Those expenses are only generated when I'm actually selling. All right? And so let's just take a second and think about what contribution margin really does in a business. Now there's a great graph up here, a great chart with a what if, and shows you 3 examples. If you go to m1talks.com, punch in your information, you're gonna get a copy of this, and the what if that you're gonna need. So this is a $750,000 store with 30% of its revenue committed to fixed expenses. It has variable expenses of 17%. Variable, those expenses that are tied directly to selling. So my expenses in this business are 47% of my revenue. If my cost of purchase, the goods that I buy from my vendors, equals 53, it gives me a contribution margin of 30%, and in fact, I'm gonna lose $600 this year. And so the smallest adjustment in your business will turn back to positive cash. So look at example 2, same revenue, $750,000. We lowered our fixed expenses by 1%. We lowered our purchases by 1%, and we generated $18,000 in business, or pardon me, in cash flow. How many people can leave here today and reduce their expenses by 1%? Everybody can leave here and reduce their expenses by 1%. Everybody can lower their cost of purchase. How do you lower your cost of purchase without lowering sales? How do you buy a little bit less inventory without it negatively impacting revenue? What's the answer? I buy the right inventory. More importantly, I buy the right inventory at the right time. It takes less of the right inventory to generate revenue than it does of bad inventory. How long does it take to move bad inventory? How long does it take to move those sweaters that were here last year? Right? When was the last time she came in and said, could you show me something from last season? Right? Lower your cost of purchase by buying the right inventory at the right time. And lowering that cost of purchase by 1% generated $18,000 in cash. Our contribution margin went from 30% to 31%. Jump to the next example, where our contribution margin goes up by 32%. And all we did was take the expenses in the store, the fixed expenses, and drop it by 3%. If you've got $100,000 in fixed expenses in your store, do you think you can find $3,000 to tighten up? More importantly, could you convert some fixed to variable expense? Expense that's tied directly to sales? So let's talk about expenses. There are 3 types of expenses, operating expenses in your store today. There is those fixed expenses, what we call overhead. What's an example of a fixed expense? Rent, insurance, right? Things that doesn't matter what happens, I pay. The minute I open the front door, I'm paying for those expenses. I don't have to open the front door, I'm paying for them every month. We then have variable expenses, like I talked about, those expenses that are directly tied to revenue. What's an example of that? Payroll, commission, merchant fees, your credit card processing fees. Those expenses are only generated when you actually sell something. And then we have hidden expenses. Hidden expenses that are buried deep on your balance sheet that you don't even recognize are coming out of the business every day. And so let's think about, how do we benchmark expenses? How do we budget? How do we benchmark what they should be? I'll give you an example. If you are in a strip mall, your rent as a percentage of revenue should land somewhere between 6 and 9%. If you're inside a mall, it's probably sometimes twice that much. And it's because there's a direct correlation between rent and advertising. Rent and advertising together, you should be spending somewhere in an average store between 1 and 3% of your revenue on advertising. Now, if someone else is advertising for you, i.e. you're in a mall, you can lower your advertising expense and it gets converted to rent. The higher your rent, the lower your advertising, right? And so when we think about, how do I start to convert expenses, how do I start to mitigate or reduce expenses, I want you to think about how much it takes to cover off poor operating expenses. You know, we have to be lean in expense. Not this kind of lean. Lean in expense. As tight as we can be. If you've got $1,000 in subjective expense, how much does it actually cost you to cover that $1,000? How much more in revenue do you have to generate to cover that $1,000? It's not 1,000, it's 2,000. Think of the stress that you put on yourself every day to generate more revenue to cover off bad operating expenses. Set a benchmark on every expense. How many people use budgeting? How many people use QuickBooks, Sage, Simply? How many people use the budgeting feature? Why not? Why don't you want to know where you're going? Why don't you want to know where your expenses will be? What were they last month? Is there a good chance it's going to be the same this month? Or last quarter and this quarter? It's the click of a button and it produces a budget. And measure your performance against that. Set a benchmark. Hey, this guy at Magic, Dan, said my rent should be 9% of my revenue and it's at 12. What do I do? Well, there's 2 things you can do. You can lower your rent or increase your sales. Or a combination of both. I think it's ultra important that you recognize how much poor operating expenses actually cost us. If I need to cover off $1,000, I've got to go buy the inventory that I can sell to cover that off. And remember, if I've got variable expenses, I'm generating in some cases $2,000 and $3,000 in more sales every month to cover off that $500 to $1,000 expense that I shouldn't have. Every expense in your business should be benchmarked. It should be measured every single month and improved. That which we measure, we can improve. You should measure your expenses, every single one of them. This is where my payroll is. This is where my rent is. This is where my utility costs are. This is where my admin costs are, my office expenses, my selling supplies. Measure it and try to tighten that number up. When you don't have expense, where does the revenue get to go? When I lower my fixed expenses, it gets out of the car sooner. I get to break even faster. I get to go on vacation more. Or at least on vacation. How many people pay their expenses on time, every single month? How many people pay themselves on time, every single month? Fix your operating expenses and you'll start paying yourself more. Look at what they are and figure out how to get them down. Talk to one of the 10 people that are standing on that wall. Not only are these people inventory specialists, they're like management accountants. They're looking at your financials and saying, here's where you need to tighten up. Here's where your industry is aligned. This is where your payroll is. How do we get it down? How do we convert it? How do we drive a little bit more revenue to offset some of those expenses? Okay, your balance sheet. Does everybody know what their balance sheet is? Does anybody look at their balance sheet and are puzzled by it, like me? Your balance sheet is really made up of 3 things. Assets, what you own. Liabilities, what you owe. And shareholder equity, your stock value, your retained earnings. And so what really are our assets? Well, it's our cash. In some cases, receivables, if you carry any. And inventory on a balance sheet. Now, I put asterisks beside inventory. Why? Is inventory really an asset? Now, you're saying that because you think that's what I want you to say. Do you believe inventory is an asset? Put your hand up if you believe inventory is an asset. Well, I'm going to let you in on a little secret. Inventory is your greatest liability. Inventory is in fact a liability. Why do I say that? What happens to inventory hanging on the rack? It devalues itself. It depreciates, and we don't recognize that. We treat inventory at its cost value as an asset on our balance sheet. But the reality is it's a liability. It only becomes an asset when we sell it. You think of your stock market. Anybody have stocks? Anybody play in the stock market? Everybody know what an unrealized gain is? Or an unrealized loss in the stock market? It's the representation of your inventory not being sold. More often, it's an unrealized loss. And so I want you to think about assets a little bit differently. That inventory that's an asset is a catalyst to cash. It doesn't help you get financing. Your liabilities, your payables, your rent, your people, your taxes, your debt. Probably the #1 largest contributor to a lack of cash flow. We hit this season, we get through, we're in buying mode, and inventory starts to land in the store, and then sales starts to pick up, and we generate a bunch of free cash, unencumbered cash, and we go pay back all of our debt, leaving ourselves without cash to buy more inventory. You have to think about what that debt represents on your balance sheet. Debt is healthy. To an extent, debt is healthy. You need to have healthy debt in your business. And so you also have taxes, and you have this hidden cash that leaves the business on a regular basis. It is the debt repayments. It is in some cases employee obligations. We see interest on your profit and loss or your income statement, but we don't ever see the debt payment that leaves. You have a $1,000 loan payment. We attribute the interest from that $1,000 loan payment on your profit and loss statement. But the rest, we don't show it anywhere. It's on a balance sheet. It grossly impacts your cash position. And so you need to better understand exactly what my balance sheet is saying, where my cash is being stored or hidden, to build a proper cash flow projection. Does that make sense? Is it a little too? Right? We need to know where that cash is. And so when I talk about cash flow is the real or virtual movement of monies in and out of a business. Real money out, payroll, out. Debt payment, the virtual movement of cash, gone. And cash flow is the lifeblood of your business. No cash, no inventory, no inventory, no sales. No sales, no cash, no cash, no inventory, no inventory, no sales, no sales, no cash. Well, we can go on like this forever. All right, it's a dog chasing its tail. Cash and cash flow and the ability to predict where your cash flow peaks and valleys. There are peaks and valleys, trust me. They will help you identify peaks and valleys in cash flow. The ability to manage or measure that cash flow going forward will allow you to better grow your business, to invest cash in inventory that's going to create more cash. Every business has to have a cash flow projection, even the most simplistic cash flow projection. Revenue minus my operating expenses, minus my purchases, not my cost of goods sold. I don't want you to calculate what you've sold. I want you to think about what you're buying. That's the true representation of cash out of the business. Revenue minus my cost of purchases, how much I'm paying my vendors, how much inventory I'm buying, minus my operating expense, minus my debt payments, equals my cash flow. If you use all of that available cash to pay back debt, you stymie growth in your retail store. Right? And so your ability, to the extent or to the degree that you can forecast cash, that you can predict where your cash will be a great indicator of how opportunistic your growth is in your store, how much opportunity there is. How many people predict revenue in their stores? How many people have a sales projection for next week, next month, next 12 months? Right? Great leaders, good leaders, have the ability to be good predictors. They create systems that define outcomes. I predict my sales will be here. In order to achieve that, I must buy this much inventory. I'm investing in X amount of inventory to achieve those sales. That's prediction. The better you are at predicting sales and the required purchasing that's associated with sales, the better you'll be able to predict your cash flow. How many people would like to know how much cash they'll have at the end of next month? Right? Who doesn't want to know that? Where's my cash going to come from? How am I going to know? You need to use this most simplistic cash flow statement. Sales minus cost of purchase minus my normalized operating expenses, whatever they are. Look at them for the last 12 months. This is how much I spend on operating my store. There's a good chance if I spent this much in the last 12, I'm probably going to spend this much in the next 12. Right? Want to drive some cash flow? Look at that inventory that's sitting idle in your store today. If it didn't sell in the last 3 months, what makes you think it's going to sell in the next 3? And you need to turn that back to cash so that you can effectively grow your business and identify one of the key measurables in understanding financials in growing cash flow. Right? Questions? Yeah. Yeah, what's payroll? So I said some benchmarks. I talked about rent and advertising. What's payroll? What a good question. So what do you think payroll expenses should equate to in your store? Where should they be benchmarked? Does anybody know where they are today in their stores? As a percentage of revenue, payroll probably lands somewhere between 12 and 15%. Payroll in its entirety. Your contribution as well as what you pay your people. So let's use your calculator. Get your calculator out. Let's start in the calculator at 100. Now I want you to reduce minus from that 100 your cost of purchase. How much you're going to spend on inventory. Let's just look at next month. What percentage will you spend on inventory of your revenue? These examples I showed you. Ooh, this thing's aggressive. 53, somewhere between, we're going to start at 51 to 53. For every dollar I sell, I'm going to give 50 cents to a vendor to buy inventory. That's what I did last month. That's what I'm going to do next month. Let's use 50 for fun. 100 minus 50 is 50. What's next? I'm going to pay my rent. Let's say I'm really good, 9%. So take 9 off of it. We're left with 41. Let's take payroll off. How many people think that their payroll lands in that 12 to 15%? How many people think it's higher than that? All right, what number is it? Throw it out there, shout it. 22%, take 22 off. And we're left with 19? Okay, we got 19% left. What else do we have to pay? Advertising. How much are you spending on advertising today? To generate $1,000 in sales, am I spending $100? Am I spending $10? What am I doing? Let's say that you're right in the middle of the road, take 2% off for advertising. How about your cost of sales? Your bags, your tissues, your wrap station. How much do you think those supplies are costing? How much do you think your computer system, your POS costs every month? Let's say that those costs are, you think it's 10%? Okay, take 10% off. We're left with 7%. What haven't we paid yet? We haven't paid ourselves probably, yeah, that's a good point. We haven't paid our heat, we haven't paid our hydro or electricity. We haven't paid for our telephones. It's probably 3 to 5% that we haven't paid. That captures that. What else am I missing? We've got some debt repayment. So we've got some debt that we're paying back. And what if we're contributing today 1% of our revenue to pay back debt? All of a sudden we're at 0 and we didn't look after ourselves yet. So how do we get that 20% payroll down to 12? What do we need to do? What's the obvious answer? Increase sales. How do we increase sales? There's 2 things that increase sales. The right inventory and the right people. That's it. No secret. No tricks, no trickery, no shifty salespeople. I have the right inventory and the right people. You need to get that 22 or 20 or 22% down to 10. You see, the way I start, I always start with that 100 and I say, well, how much do I need at the end of the day? What's my sustainability factor? How much cash do I have to have left over at the end of the day to be able to grow my business tomorrow? Well, if it's less than 10, it's probably not going to work for me. So now all of a sudden I only have $90 to play with. Right? This is a pure example of how just the smallest adjustments fix that. When I talk about fixed expenses, how many people pay their staff on commission and versus fixed payroll, salary I should have said, hourly or salary? Hourly and salary is a fixed expense. The lower that fixed expense, the faster I hit break even. The faster I hit break even, the more cash I have. Your people need to be on an incentivized payroll plan. It's a win-win. They sell more, they make more. We make more. It's we, the three. It's win-win-win. Start to convert some of that expense down. And so if you start with profit first, I take that 100 and I say, okay, I need 10%. Just to be sustainable, I've now got 90 bucks left. Well, how do I lower my cost of purchase? Yeah, buy inventory at the right time, certainly the right inventory at the right time. Look for opportunities to fill in, to buy inventory in some cases on a discount. Better than on discount, have the ability to sell it at full price, not on markdown. I asked a group last week, what's your biggest expense in your business? By far the biggest expense. What do you think it is? How many people believe it's markdowns? You got to understand where they're coming from. Where do those markdowns come from? You know, we started with that 100 in a perfect world. If I'm carrying 25% markdown, I'm really lowering from the 100 to 75. I'm giving away dollars. I'm bribing customers to buy my goods. And it's increasing my break-even point. You have to know in your business, when will I be profitable? No offense to the accountants, but when will I be profitable as in have cash? Not white paper profit. Looks like I made 50 grand. And now I gotta pay tax on the 50 grand, but guess what? I don't have any money in the bank because I didn't protect my cash along the way. I have no idea how to unlock cash in my business. I don't know where it's held. You need to understand where your cash flow is being held hostage in your financial statements. We can talk all day long about growing sales and buying better, and all of that's gonna make a difference. But you first have to understand where that cash is being held hostage. If you're $1 million store and sitting on $500,000 in inventory at cost, I can tell you where your cash is being held hostage. Here's the number one trick to better understanding my cash in inventory. Stop looking at inventory at cost. Nobody cares what you paid for it. We only care what you can sell it for. She walks in your door and your inventory is represented to her at retail dollars. Don't look at your inventory at cost. Well, I know I marked it down, but it's okay, I only paid $12 for it. But it represented $50 that you marked it down. Your cash is locked away, it's held hostage. Start looking at inventory at its retail value or its real value. And it will help you start to unlock some of that cash that's tied up. Make sure that on your profit and loss statement, you start to group expenses. What are my occupancy? What things cover my occupancy? And let's get a benchmark on it. Rent, electricity, gas, insurance, all of those fixed expenses that group up to be covered under rent. Wherever it is today is fine. Let's figure out how do we improve it tomorrow? How do I reduce that number tomorrow? How do I convert some of that rent or some of that fixed expense to variable so that it's completely tied to my revenue generation and lowering that break even? Figure out where those expenses are. Figure out where your admin expenses are, right? Every line item on a profit and loss statement should go somewhere. It should be grouped together. This is my operating expense. This is my cost of sale. This is my occupancy. This is my payroll. This is my advertising. These are my donations. Benchmark, code every one of those expenses and forecast where they're going to be and show yourself where your cash is. Look at your debt. Make sure that you have healthy debt. Healthy. You know, that you have a quick ratio. You have the ability to pay back debt with cash in a 12-month period. Let's look at what that debt looks like. Start to forecast where your cash flow is going to be. How do I get to cash flow again? How do I figure out my cash? Sales minus cost of purchase, how much I'm spending on inventory, minus my operating expense, right? Revenue minus cost of purchase is cash margin. A good number to look at. What's my cash margin? My forecasting at 50%, meaning at any given time I'm dedicating $50 to my vendors. And now I've got $50 to pay my expenses. And if we add up the expenses in column 1, they're 47%, leaves me 3%. It's not 10, it's not 12, but it's a start. Figure out the best way to start unlocking tied up cash flow, looking at just your financials. The stress that we put on ourselves in trying to grow sales is unbelievable. When was the last time you asked yourself, what are my earnings? How many people compare earnings month over month, year over year? You compare sales. How much more do we have to generate in revenue to cover off excessive operating expenses? If you want some help looking at your expenses, looking at where they should be, setting up actual benchmarks, stop and talk to me. I'm going to hang around any one of the 12 people that are over on your right. Every one of them has the ability to do a financial analysis. I know it says inventory. We're happy to do that too. Happy to show you in which classes you're making money, where you're giving up money, where you're tying up cash you don't need to. But start simply with a financial analysis. Learn where your expenses should be, where they're aligned with industry. Go to m1talks.com, pop your name in, you're going to get a copy of the presentation, and they'll reach out. Or better yet, they're standing right there waiting to talk to you. My name's Dan Holman. I hope you have a great rest of the show. If you have questions, I'm going to hang out here by the side. Thank you.